So Disney is historically it's been a really great company. I think they were like one of the most valuable companies at one time, right? And not too long ago, they were quite a bit more valuable, trading above 100, close to $200 per share um, on 2021. But the stock has really sold off. Go ahead, Mike.
Hey, Victor, I just wanted to tell you I appreciate everything today. I've actually got to sign off. My family is almost going to be here in just a minute.
Okay.
We're going to do some stuff this afternoon. So I apologize, guys, but have a good one.
Yeah, thanks, Mike. Thanks for tuning in. Have fun today.
Yeah, thank you. Bye-bye.
So Disney, if you look at like the 5-year from 2021 to now, it's down 45.7%. Now, a lot of stocks went down in 2022, but this one never went up. They got a CEO and he just couldn't get the market to the stock to work. And the 1 year doesn't look too bad. It's been beginning to work, from last couple months, it's up close to 16%. That's pretty good. Year to date, it's down 4%. Okay. So let's take a look at Disney. I can tell you a couple things that I don't like about Disney, but I'll mention those along the way. It's still a pretty good market cap company at $193 billion, $91 billion of revenue. Their 4P looks great, 19.74. A lot of analysts like it. Small, reasonable discount, 17.5%. So when we look at their financials, they're showing growth. And the growth in the most recent quarter looks quite nice, 6.2%. A little much higher than 3-4 quarters ago. So that's good. That is a green flag. That looks good. So we have a little bit of growth, single digit. If they could go to double digits, boy, that'd really make the stock even more attractive. When we look at their gross profit margins, 35%. That's a little expected because they run theme parks and they run a variety of things. This is a conglomerate company. They have movie studios, theme parks. They're trying to do streaming with Disney Plus. They do television stations like ABC. They do ESPN. They're a little bit, some of their assets are losing value, like their cable assets, like ESPN. That's lost a lot of value. It's still valuable, but nowhere near what it used to be. Now, one number that really looks good is this free cash flow growth. That looks good. See how it used to be great and then it dropped off. Didn't look good. But now they're like, hey, you know what? We got to generate some cash. And they've been doing so. So $8.5 billion of free cash flow looks pretty darn good to me. Let's take a look at their balance sheet and see if it looks like it's in good position. So cash $6 billion, debt $49.5 billion. They do EBITDA of 17. So they're less than 3 times EBITDA. If we look at net debt, so just slightly under 3 times EBITDA. So that's okay. So Disney, looking at their free cash flow at $8 billion. This is a good quality business. Let's say I went to 20 times $8 billion. I get to about $160 billion of value, not quite $193 billion. And then you have to add the debt. So I still think based on free cash flows, this is not going to work for me. They'd have to increase their free cash flow probably up to like 12 or 14 billion in order for it to get interesting. Analysts think there's 24 analysts covering it, providing price targets. There are some bears mixed in there that say, hey, the stock is going to go down to $95 per share. Some analysts are very optimistic. Hey, it's going to go up to 147. That looks good. The growth rate. So growth is going to be single digit, middle single digits, like 5% growth for the next couple of years. It's going to drop a little bit. So no exciting growth on the horizon. The earnings per share is going to expand nicely, 13%, then almost 12% here. And the PE looks good. Looks reasonable. This is like a value stock now. This is not a high growth stock. It's a pass for me. I just don't know if this one's going to double over the next 5 years. And wouldn't be surprised if it just kind of goes up 25%, 30% over the next 5 years. It doesn't pay a very high dividend. I think the CEO's work is still cut out for him. He's going to need to make the company exciting again. It's had great years in the past, but I mean, they got really strong competition from Netflix as it relates to streaming, and they have competition like the theme park business. is great that, hey, Disney theme parks are very desirable by a lot of vacationers, but they're really expensive to run. You've got to hire a lot of people. It's expensive properties, and you got, a lot of things going on. For example, when we had the hurricanes hit Florida, they had to shut down Disney World in Florida. That had to be super expensive. And then you have a lot of expense involved in the theme park business. The cable business is going away, and I think that really affects Disney. They're not the leader in streaming. That's putting it as politely as I can. The leaders, Netflix, YouTube, even Amazon Prime. Those are the ones that are taking the lion's share of the market space. The ones that are outside looking in are Disney with Disney Plus, Apple, which is trying to get into the streaming business. I don't know if they are successful in doing so. So for now, Disney is a pass. I know some investors are excited about what could happen, but I need to follow my fundamental analysis and kind of pick companies that I think are undervalued and really show the fundamentals that are going to drive the stock higher. And there's a good story around it. And I don't think Disney checks enough boxes for me to feel like, hey, this is a good stock for me. So that is Disney.